Hi, this is Bob Schill from Canopy Mortgage with your weekly update. The Federal Reserve just cut rates by 0.25%, which is the third cut this year, after similar moves in September and October. So this is a slow, gradual easing trend, not a big emergency slash of rates. But here is where it gets interesting. The vote inside the Fed was split. One member wanted a bigger 0.5% cut, and two members didn't want to cut at all. This is the biggest disagreement we have seen inside the Federal Reserve in years. So, what does that mean for you and for mortgages? First, mortgage rates do not move in a straight line with the Fed funds rate. They follow what investors expect for inflation and the broader economy, not just what the Fed does at one meeting. Because this cut was widely expected, a lot of it was already priced into the bond market. That means mortgage rates do not drop overnight just because the Fed moved by 0.25 point. In fact, on some recent rate cuts, mortgage rates have actually stayed flat or even ticked up a little as markets react to the Fed's comments, not just the headline. Second, the outlook the Fed gave for 2026 matters. Right now, they're only projecting one more small cut next year. And some members are still arguing for more cuts or no more cuts and even a possible hike. That tells you the Fed is not convinced that inflation is fully tamed. This means you will likely see windows of opportunity where rates dip and then bounce rather than one smooth decline. If you have any questions, please reach out to me 843 685 1685.